February natural gas futures moved higher on Monday, supported by the expiration of the January contract, forecasts calling for a modest cooling trend, and anticipation ahead of the EIA storage report due at 12 p.m. The EIA reported a 166 billion cubic feet withdrawal in U.S. natural gas storage for the week, broadly matching market expectations of a 165 to 170 billion cubic feet draw and leaving the report essentially in line with consensus. Total working gas in storage now stands near 3,413 billion cubic feet, sitting 3.6% below last year's level and about 0.7% under the 5-year average. Regionally, withdrawals were concentrated in the Midwest and East, reflecting colder conditions, while the South-Central draw was partially offset by strong production and steady inflows. Despite the sizable weekly pull, storage remains relatively comfortable for late December, supported by record lower 48 production near 109.8 billion cubic feet per day. Overall, the 166 billion cubic feet draw is modestly supportive but not decisive. Inventories are tightening on a seasonal basis, but remain sufficient to keep price action driven primarily by weather forecast changes and technical levels, rather than storage data alone. Meanwhile, several chilly weather systems are expected to track across the Great Lakes, Ohio Valley, and Northeast over the next 6 days, lifting national demand. Meteorologists project a slight nationwide temperature drop through January 10, with heating degree days rising from 377 last week to 398 currently. While this remains well below the normal level of 449, forecasters are watching for colder risks beyond that period. That said, much of the 8 to 15-day outlook still leans too warm across key regions. Analysts estimate that average natural gas demand in the U.S., including exports, will increase from 136.1 billion cubic feet per day this week to 138.5 billion cubic feet per day over the next 2 weeks. On the supply side, average lower 48 production climbed to a record 109.8 billion cubic feet per day in December, topping November's prior monthly high of 109.6 billion cubic feet per day. LNG fundamentals remain supportive. Average gas flows to the 8 major U.S. LNG export terminals have averaged 18.4 billion cubic feet per day so far this month, up from the previous monthly record of 18.2 billion cubic feet per day in November. Freeport LNG also confirmed that all 3 liquefaction trains at its 2.2 billion cubic feet per day Texas facility have fully resumed operations after a temporary outage linked to feed gas disruptions. Positioning data, however, shows some cooling and speculative enthusiasm. Natural gas speculators across 4 major NYMEX and ICE markets cut net long positions by 75,000 contracts to roughly 164,000 in the week ending December 16, according to the latest CFTC report. In other news, Russia delayed its plan to reach 100 million metric tons per year of LNG capacity by several years, Deputy Prime Minister Alexander Novak said Thursday, citing the ongoing impact of Western sanctions on the country's energy sector. February natural gas remains technically fragile despite Monday's bounce. The rally looks more rollover and weather-driven than trend-changing, and price action is still capped by key moving averages. On the upside, initial resistance sits in the $4.20 zone, where prior congestion and short-term sellers are likely to re-emerge. A sustained daily close above $4.40 would be required to confirm momentum and open the door toward $4.60. Aligning with the upper range resistance and longer-term technical pivots. On the downside, near-term support is clustered around $3.90. A decisive break below this area would likely trigger another leg lower toward $3.50, where buyers previously stepped in and where technical demand could reappear. Failure there would expose the broader lower $3.40 zone. Momentum indicators remain mixed to weak, suggesting any upside is still corrective unless confirmed by follow-through volume and stronger cold revisions. As long as prices remain below the 50-day and 200-day moving averages, the broader bias favors range trading with downside risk, while rallies are likely to be sold until proven otherwise. If you enjoyed the analysis, drop a comment, hit like and consider supporting the channel. It really helps keep things moving, and see you next time.